I'm Keith McCullough, and welcome back to day 2 of our investing summit. Yesterday was quite productive for me in these conversations. I learned quite a bit, and I love having these discussions. When you go for 3 full hours with the types of players we have in the game, you get an opportunity to learn. So what we like to do is focus on people that are principled people, good people. On Wall Street, you can still find those, and definitely one of my favorite people on Wall Street. Welcoming her back, the one and only Liz Ann Sonders. Thank you for making time today. We appreciate it.
Hi, Keith. Nice to be here, as always.
Well, we're going to go through, more of a rapid fire, not that we need to speed it up, so to speak, but since you can cover so much ground and so many people are familiar with you, I think I've complimented you multiple times, but just to do it one more time, like what you're doing in terms of you and your team, just like me, it requires a team to do what you're doing, which is really impressive. But what you're contributing to the community on Twitter every day with its daily process, and I think that that's super helpful given the alternative, which is a lot of noise, Liz Ann, people can listen to, right? And you do a really good job just staying with the data. You're not like me. You don't go off on some tangent about hockey or something like that. You keep it right up the middle.
Sometimes I go on dog tangents or kid tangents, but I certainly don't go on political tangents. So that's kept things a little more sane for me.
Well, you go with what you love, I have to go with, I have this love-hater thing going on out there that I have to sometimes address, but it's...
Believe me, I think we all have a love-hate relationship with social media. No question.
You get what you get. It's just, I kind of think of it, and you're an athlete, so you get it. And in Darien, Connecticut, where your kids grew up, you have this intense, competitive arena.
Yeah, almost too much so.
Particularly, Darien lacrosse. But it's one of the best high schools in America for lacrosse. And I look at this this experience on Twitter as being in the Yale hockey arena is one thing, but having the dude literally with the popcorn be able to tap you on the shoulder in between shifts, that's interesting, right? It's never happened that way, but it's okay. I think I'm finally okay with it. My hair's gone completely white and gray, but yours still looks good.
Yeah, well, who knows what the natural color actually is?
Oh, my wife says it all the time. So just to get, I want to start with this bridging of, in my model, as you know, we have the quads. We have growth and inflation, rate of change terms, and how they impact the profit cycle. So I want to go through all three. But for a long time, we really didn't have to address, for almost our entire career of time, for you and I, which is a long time, we didn't really have to address the inflation component. Now it's really become, if you look at that three-legged stool, it's become everyone's fascination. I've called it a mania. And we're transitioning to where, at least I think, the recession and the profit recession in particular is much more important to your forward-looking risk management and returns. So one, do you agree with that? And two, if you do or you don't, what is the transition that you see here?
So I think we're probably in the process of transitioning to what I've been calling the temperamental era. And it's just my descriptor for really the 3-decade era that preceded the era of great moderation. The Larry Summers coined term for that. Maybe the temperamental era will catch on, and I'll get credit like Larry did for that. But that really defined the period from the mid to late 60s up until the mid to late 90s. And it wasn't an environment of perpetually higher inflation, but it was an environment of more volatility in inflation. There was also more geopolitical volatility. Economic cycles were shorter, i.e. more recessions, although the growth phases tend to be more robust on the upside. Fast forward to the 20 plus years pre-pandemic, the so-called Great Moderation, that was an era where everything, I've been using the acronym GELD, everything GELD, G-E-L. We had cheap access to goods, energy, labor, and for the most part, those ships have sailed. And I just think we're transitioning into a very different environment. I started in the business in the mid 80s, so I had some experience with that. I grew up in the 70s, so I certainly had experience with that. era of volatility. And I just think it's a different backdrop than a lot of investors, not just the newbies, the newly minted day traders. It's just a different backdrop, and it's something I think we're going to have to get used to. And the last thing I'll say is one of the defining characteristics of those two eras was the 30 years, the temperamental era was one where for almost the entire period of time, save for brief moments, you had an inverse correlation between yields and stock prices. Because often when yields were moving up quickly in that era, it was because inflation was out of the bag again, ergo negative for equities in general. The era of great moderation, typically when yields were rising, it wasn't because of a serious inflation problem. It was a sign of improvement in growth. That's a nirvana backdrop for equities. We recently had a move back into positive correlation territory with yields and stock prices, but that's moved back to negative. That, to me, if it continues, may be sort of the quantifiable signpost that the era is changing.
Yeah, I would very much appreciate that. Let's just start from an asset allocation perspective. Because there are many more things that I can allocate to as opposed to having this straight up positive correlation where both stocks and bonds go down, just to simplify. And maybe that's why I have 19 different asset allocations all of a sudden. Like today I'm buying investment grade credit, defensive investment grade credit. You'd have that relationship as well where, on days like today, you wouldn't have to be as fearful of the beast that is that is bond yields or inflation itself. And I guess that's my follow-up question to this. I quite like that, the temperamental, because when you say that, and I think about it, within my own thick skull of sine curves and cycles, I think of that as my kids. Because you go from something in its infancy, I have 4 of them, but I have 2 of them that are in the temperamental stage, which are they're teenagers. And you have the other 2 that that's still in the infancy. But if we substitute inflation for my children, that's essentially it. We have a base pack here. We're not going to break down below 4%, at least on my numbers on inflation, or much below that. And there's a lot of stuff that happens after that I'm not quite used to. And I look at my wife. My wife's like, "What's going on?" I'm like, "I don't know. Maybe we should just stop. We should just go for a walk." And from a market perspective, you can really look. I think you can look at it that way too. It's the volatility. People are like losing their minds because all of a sudden the VIX is at 16, 17. Well, it could be like that. That behavior of our child today could be 28 VIX like next week.
And we're also seeing massive volatility, or we have in the fixed income market. So
yes,
whereas the VIX has been somewhat suppressed, move at times has been off the chart. I think that's another bit of a conundrum here. Is there's sort of 3 different narratives emanating from what the Fed is actually saying, what's embedded in what's going on in the bond market, and then what you can assume is built into expectations for the equity market. And I don't think all 3 of those narratives, which are different, can coexist in perpetuity.
Well, no. And that's what is really whipping people around right now. It's like they can't find their narrative. And if you're narrative driven, that's a tough spot to be. You and I are numbers driven. We're in similar, at least foundational stance. We do a lot of rate of change. I really only focus on rate of change. So that's really my question now. Like as we go, the place that an inverse relationship, a positive relationship goes to inverse on stocks versus bonds is that it becomes more clear to even the Federal Reserve itself that we've not only entered a recession, but we're slowing faster throughout one. That's as typical gets, and I think that at least to me that's why gold has finally broken out and likely breaks out to all-time highs. So what do you think about that? Where are you on that? First of all, I think if you look at guys, can you put up slide 14? Like I'm really low on GDP, and Stephanie Pomboy, who I think is pretty close to where I'm at. Bloomberg consensus has come down towards 1. Atlanta Fed, I think, is in la-la land. They're still, if you look at it methodologically, their numbers got a 2 in front of it because they're really anchoring on the January numbers, which were much stronger than March. Where do you fit, like, on that continuum of GDP? Like, how fast are we slowing? Do you think we're not slowing? Like where are you at on that?
So let me start with a broader answer in terms of how we've been defining this cycle using the R word. We've been saying this is more of a rolling recession, very unique to this cycle where we had the initial burst of growth coming out of the lockdown phase in the early part of the pandemic, fueled by stimulus, and that gave a fillip to the good side of the economy, housing related. That's where the inflation problem began. But then that then morphed into disinflation on the good side and recession level conditions in many of those areas. But we've now had the offset on the services side. Services is a larger employer, so that's helped keep the labor market afloat. But to your point about January through March, if you look at really any number of data points, particularly those that get influenced by weather, retail sales as an example, the reported monthly, obviously, but if we think of it in the context of the quarter, since we're talking about GDP, which is quarterly, it does turn out that the January strength had a lot to do, if not everything to do, with a much warmer weather. And that provided that lift in January, but then you saw a pretty significant deceleration in February and March when you saw a more return to more normal weather, colder weather. You saw the same thing, but somewhat reversed in a metric like industrial production, which on the surface actually looked a bit better than expected when it was recently released, but it was concentrated in February and March in utilities usage. Again, a sign of weather related. Look, peeling the onion back there, under the surface, you saw a bit of weakness. So you can connect those dots and say, even if the quarter started strong on many of these metrics, it ended undoubtedly on a much weaker note.
I mean, it's amazing to see, like on the biggest thing where, and I want to get into that next, the consumer went from in great shape, the narrative was, to in good shape to, well, they're still there, to, I mean, retail sales, as you most likely well know, just dropped 465 basis points from January to where it was in March. I mean, that's not like a secret. It's not an opinion. It's a rate of change fact. So it finally got to the consumer, and I want to get into that. But first, I just wanted to show, like slide 32, what Lizanne alluded to, because we've tried to tell people, like, there are like 6 different things that created this, palooza, or this positive January in consumption growth that took you. Those numbers came from somewhere, right? And I think when you check it down, like on slide 38 through, actually just throw up slide 38, there's 5 different things you can check down on the U.S. economy, from manufacturing, which Lizanne pointed out, or industrial production growth as well, to confidence falling and CapEx falling. I mean, you have all these things happening. So, before we get into the consumer, on that, like, why do you think the Federal Reserve is so, like, reticent to just talk about that? Like, why not talk about that? This is, they can't be at this day and age. I mean, first of all, the Atlanta Fed doesn't get that in their numbers, which I don't get. But the rate of change reports, I mean, why not just discuss that we've entered a recession, or we're entering one?
Well, keep in mind, though, that the R word was in the latest minutes. So it is somewhat rare for the Fed to actually use recession, not specifically as part of a formal forecast, but effectively saying, look, it's coming. I'm frankly really surprised that there are still so many adherents to the no recession or soft landing. You don't hear so much no landing anymore. I think that was kind of every time I heard it, I'd literally sometimes say out loud, what? What are you talking about? So I think that the Fed is being about as honest about the situation as you have typically seen the Fed, versus eras like 2008, where you had Bernanke saying, no problems in the mortgage market, no problem in the housing market, nothing to see here. Yeah. Maybe exaggerating a little bit for effect, but so the rub for me with regard to the Fed, and this is not some brilliant thought here, and the Fed essentially concedes this, is they're extraordinarily focused on data that is inherently lagging in nature, conceding that the effects of their policy changes are very much in the future. But they're still making policy decisions based on these inflation stats. And I happen to agree with you. I think that, there's always the bullwhip effect, the boomerang, where I think there will continue to be disinflation. How quickly, or if at all, near term, it can get to something with a two handle, that may be tougher. And I don't think the Fed is going to do any kind of formal change to its target. I think what will be interesting is if we, maybe get into a three handle, whether you see subtle or otherwise some language change on the part of Powell or any other number of, Federal Open Mouth Committee members.
Well, you didn't criticize him, but you did. That was a good Fed joke. And we have a lot of cartoons of the Fed, so if you want to pop those up, Eric, at your will. But the yield curve itself actually looks exactly like what you just verbalized. Okay, like today I could show it. Today we're at minus 64 basis points on 10s twos. That means the Fed's going to stay hawkish on the short end, and the long end's starting to really have a come to Jesus moment here with the cycle. I mean, that's how the curve reinverts, further. I mean, thank you for that, Eric. Nice little cartoon. By the way, I just want to go to slide 5 so I can do what Lizanne did. I do think a big part of this investing summit, and just you and I in general, I think we believe in trying to help educate people on like this whole thing called the cycle. So when you said, I don't even know what that is on soft landing, like this.
No, I don't know what a no landing is.
No landing.
I get what a soft landing is. I think that ship has already sailed, but no landing, I don't understand.
Yeah, no landing. Okay, so everything Lizanne and I do, and please correct me if I'm wrong, Lizanne, I'm trying to make the most basic lesson that if anybody leaves this today and they don't know you or I, this is what they come away with. This is being on the right side of the sine curve. That's called an acceleration. You typically accelerate into quad 2 at the top. When you're decelerating, you are going down from the cycle. The cycle peak was in 2021. You're going down here. So where you're trying to get to the answer that Wall Street, everyone's debating, correct me if I'm wrong, Lizanne, is like, are you here, right? There's no such thing as no landing.
Right. Exactly.
It's where are you here? And that's one of the, again, correct anything that I just said if you'd like to, or expand on it. I mean, there are things that Wall Street starts to say and Twitter amplifies. I mean, ChatGPT would not, even validate no landing. I mean, so just trying to help people talk about the things that actually matter, and maybe try to simplify macro a little bit more because it is quite complex.
Well, so I suppose if you make a generalization based on what people describe as the conditions tied to this, no landing scenario, it would be inflation continuing to come down, but no hit to economic growth from here, and or the labor market, sort of this, immaculate disinflation, meaning then the Fed can pause. And I've even said, and then they can start cutting rates, and then we're off to the races again. And I think that doesn't make sense. This idea, and that's what I think is still the disconnect, potentially embedded in what's happened in the equity market, is that the Fed is saying we're going to get to the terminal rate, maybe at May, maybe June, who knows, but sooner rather than later. And then we're going to stay there for a while. Now, that's not a definitive promise because they're data dependent. However, the idea that the Fed, and this is built into, Fed funds futures, that the Fed will start cutting rates, that's certainly possible, but not if everything else kind of stays around where it is right now.
Right.
The Fed, I think, will pause, makes sense at some point, but pivot will only come if either there's much more stress in the banking system than what we see in this relative calm period right now, and or you really see a hit to the economy, and in particular the labor market. This idea that with inflation not anywhere near the target yet, but no hit to the economy or the labor market, how does that represent a pivot to rate cuts? To me, the only thing that would do is really just crush the Fed's credibility. So right. I just think I think not that we should take the Fed at their words that they're going to pause and then stay there for a while, but I think that should be the default case, save for much more of an economic or banking system disruption that would force the hand of the Fed to move to cuts.
Yep, really well done, professional indeed. So just to take what Lizanne just said, by the way, I used 6 different points here, Lizanne, for a reason. Those are my monthly data points. My monthly Nowcast is 30 different data points. So I'm thinking, first of all, I'm right here, right? I'm right here. The Atlanta Fed is still up here, right? So we have the January, February, March data. So it's slowed at a faster pace. The market may very well have this right on rate cut, because I'm at -2 GDP back-to-back quarters from here to here, right? If you get -2 back-to-back quarters and the Atlanta Fed's at +2 and the Fed's saying we're not going to have a recession until the back half of the year, then the market's trying to pull forward a rate cut because the Fed has to acknowledge you're in a recession. That's how I've tried to interpret it at this point. I think that's how the bond market's interpreting it. I'm certain that that's how gold's interpreting it. But then you got equity people over here in non-chat GPT land. Like, we're talking like way out there relative to what I just went through.
And the only thing I'll say there is that the indexes obviously have been flattered by the concentration in terms of performance. And it is a bit like the duck on the smooth surface with the feet going much more rapidly under this surface. There has been churn, and I think a lot of the leadership or lack thereof does reflect a lot of what's going on in the macro environment. But there's one other thing just popped into my head when you were talking about the yield curve is the recent start of a bit of a re-steepening. I can't tell you how many times in that short period of time I got emails or questions or Twitter messages saying this is the definitive sign that there's no recession because the yield curve is starting to uninvert. And each time I would hear that, I think, well, just look at a long-term chart of the yield spread. It's almost like I've been using the weather analogy. The inversion is the watch. The re-steepening is actually the warning. So this idea that you go to such a deep inversion and then start to steepen, that actually is saying, okay, recession is sooner rather than later, not, oh, no more recession risk because we don't have a deep inversion anymore.
Yes, it's as the best soccer player, girls soccer player in Westport always says from the sidelines, because he coaches my daughters, well done. Well done. And it's like, did you see, did we pop up the 10s2 spread, the long-term chart? Did you already see that? Is that what you're talking about in terms of what I just
I did not see that, but I have
that emblazoned in your head.
Charts, and it just shows that you actually get a steepening in advance of recessions. It's not a all clear sign when the steepening starts. If anything, it's the opposite.
Well, Eric, if you show this morning's chart that I was doodling on Twitter on the 10s2, zooms it in a little bit more with some arrows. That's well done, Lizanne. That's temperamental. That's what that chart has done. That chart has tried to, quote unquote, steepen as many times as I can count at this point. And now it's just started to deepen and re-invert. That's temperamental. Trying to bet on a steepener has been, a very bad mistake for people that only trade bonds in that sense. So, this can and should go deeper the longer that the Fed stays in soft landing or no recession space. That's just what the curve. I think we're agreeing to agree on that.
Speaking of the Fed, maybe every Fed meeting these days is eventful and kind of must-see TV. In terms of the press conference after each meeting. But this is a really important one. And maybe we're all repeating ourselves by saying it, particularly because a few days later, the senior loan officer survey comes out, but the Fed gets an initial read on that. And that may be the first point we can actually directly hear from the Fed with regard to their perspective on what were already tighter lending conditions. That most recent release, which really is only through the end of last year, maybe a little bit into the beginning of this year, showed credit conditions had tightened across the spectrum of, C&I loans and consumer loans into recession territory. And that was obviously pre SVB signature, et cetera. So I think this credit stuff, which the soft data on credit, the NFIB data, some of the stuff coming out of New York Fed and Dallas Fed suggests things did not improve since then, but I think that's going to garner a lot of attention, as it should, certainly in the press conference.
Well, this is I was back and forth with Stephanie on this as well. Slide 52, guys. The phase 3 of a bear market typically, or 100% of the time, it has 100% batting average. C&I cycle kicks in, and then it broadens, and then it finds its way to what I wanted to come back to you on, which is the consumer. So the next slide, on slide 53, we're showing the C&I loans rate of change against jobless claims and against CapEx. And again, 100% batting average. So we've already seen the C&I part take off, and what happens next is job loss. What do you think about that? I mean, if I have one thing that people keep coming back to me, being bulls, trying to validate to your point, 7 stocks that equate to the 90% return, not full cycle return, year-to-date return, which is the cover your ass chase performance return. But again, what do you say to that? The labor market at this stage relative to the C&I cycle?
Well, everything points to a continued pickup in claims, both the weekly number, the 4-week average, continuing claims. In fact, the percentage increases of all of those off the recent lows, which if you look at a long-term chart, that clearly sort of gets biased by the massive spike and reversal that we saw during COVID. It makes the most recent upturn look less obvious. Yep. But the percentage increase is pretty comfortably within the range of what the typical increase is, not just as a warning of a recession, but really in the beginning part of a recession. I think that what's unique about this cycle is the top-down nature, for the most part, of layoffs. And in most cycles, it tends to be more bottom-up. And what I mean by that is, down the wage spectrum, down the, outside of the managerial, supervisory, elite segments. And then it eventually moves up and starts to hit those on the higher end of the wage spectrum into the managerial area. This has been a bit of a mirror image of that. And it's, the layoff announcements have been eye-popping because they're big blue chip kind of companies, not just in tech, but in the communications area and increasingly in financial services. But it just hasn't led to this huge surge in a metric like claims, because we've still got the hiring going on and the services side down the wage spectrum. So it's just another example of this cycle, to some degree, being kind of some oranges relative to, history's apples. But that's notable. And another reason why that didn't quickly translate into an increase in claims is, number one, a lot of the layoffs that have been announced from some of these major companies, there's severance associated with it. So there's not that allowance to file for unemployment insurance. In some cases, there might be a stigma associated with it, or there isn't that quick need from a financing your life perspective. So I think that's what's unique in the labor market. But I think the traditional measures, claims continuing to go up, eventually hitting payrolls, which have already decelerated. The last thing to move up is the unemployment rate. I think it's coming.
Yeah, and a bull of the modern era, like you alluded to at the beginning, the newly minted day traders, or people who have only been doing this for 3 years, they think that's cowbell. They think, okay, people losing their jobs in the Fed figuring out we're in a recession is cowbell. 100% of the time in the last 2 recessions that you and I have risk managed, that's not the case.
You're absolutely right.
So that's easy enough to knock that pin down. Back to just one more time on the concentration of the market. I'm very interested in your perspective, given Schwab and the base of, your community is different than Goldman Sachs. So,
right. Yeah. We're essentially all individual investors, no institutions, no hedge funds.
Right. I mean, which is, whereas, I was kind of laughing this morning at Goldman's prime brokerage note, which I'll make sure I don't misquote it. It was called, actually it was intraday yesterday at the high of the day, which is a lower high for the S&P for the cycle. It said, green shoots of FOMO buying. Get in, get in. And this has really been hard. And when I alluded to the career risk management point, from my career perspective and knowing hedge funds and how short term they are right now, that year-to-date number is killing people, because it on the one hand, they can listen to a sober discussion between two experienced people like us and say, this is really obvious, and on the other hand, they have to chase, and they quite literally have to, and the individual, I don't know if, one, they don't have to. I mean, if not all of Hedgeye Nation is the type of client that's at Schwab, somebody who's made money, wants to compound returns, doesn't want to draw it down. And then there's the crazies, like I call them the NASDAQ crazies or the crypto crazies. I'll put them on their own little community. But what do you think about all that? Like the whole behavioral component, from the institutional pressure to the FOMO in the retail community, or not?
I think there absolutely is FOMO as a force, and I think that's part of the reason for the concentration that we're seeing. I also, though, think if you wanted to try to find a fundamental narrative behind why those sort of mega cap, not tech, but techie FANG plus type names got the lift that they did at the beginning of this year, was, and sort of exacerbated by what started to unfold in the banking system, was, okay, we need to look for well-established companies that have a reasonably long history, that for the most part have strong balance sheets, that are self-funding, they have interest coverage, they don't need to access the credit markets or the banking system. And so I think there maybe was that fundamental driver, but you now have the lowest percentage of stocks within the S&P beating the S&P on a rolling 1 month, on a rolling 3-month basis. And that historically isn't always sort of a negative or Armageddon. It is the case that the last time the percentage was as low as it is now, or even a little bit lower, was 1999, which is, never a year you want to mention when talking about the equity market. But there were times where it was similar in the 50s and the market did fine. But I think all of the work that I do, whether it's sentiment-based or technicals or concentration, suggests at least a lot more choppiness here. And we have to remember that market bottoms tend to be processes over time. It's very rare to get a COVID bear market, perfect V bottom, happened in a moment, off to the races. But a lot of the newly minted day traders, their experience is really limited to the post-pandemic era. And I just think that this is a unique environment that we're in right now. I also think that equal weight in general is going to perform quite well relative to cap weight, notwithstanding this latest bout. And in fact, if you look at past periods where you've seen similar concentration, interestingly, ironically, whatever word you want to use, that has actually not been universally positive for cap weighted, but has been more consistently positive for equal weight relative to cap weight. And I just think with the return of the risk-free rate and the ability to do price discovery again, I think we're in the process maybe of reconnecting fundamentals and prices, and it's in general to the benefit of active.
Yeah, that's and you've also hit on, and I'll get to other people's questions next. By the way, if you have questions, just pop them in the queue. They'll get voted up or down. The higher quality factor exposures that I would expect to work here. Gold is basically kind of like the same thing, but like Lockheed Martin yesterday, it has all the high quality factor exposures that you'd want, including visibility of cash flow stream, pretty much everything you just rattled off. But most people instead think of their liquid molten magma stocks. It's like, but the market's finding those factors, is it not?
Yeah, absolutely. And I think, there will be a time where it'll be okay to sort of move down the quality spectrum a little bit when you're looking for that leverage to a big pickup in the economy, because that's often where there is that ability to benefit from the coming pickup in growth. I just don't think we're quite there yet. And so as a result, I think the way to think about the factors to focus on to some degree is look with a macro lens at what's kind of dear or lacking or missing. So I already mentioned things like interest coverage, self-funding companies, strong balance sheet with higher cash, free cash flow yield. If you're an income-oriented investor, don't just look at the height of the dividend yield, but look for dividend growers. Look for positive earnings revisions, positive earnings surprise. And by the way, I think you can apply screening for factors across the entire market, across the tech sector and the healthcare sector and the utilities sector. I just don't think this is the kind of market where you want to make monolithic kind of sector decisions. I think it's a factor-oriented market, and I think it's probably going to kind of stay that way for a while. And I just think it's a better way to go about making decisions than just making a monolithic sector call or two.
You know, if I could hit replay on that segment on every institutional call that I'm at, especially with the generalist, you know, if I'm with like a Fidelity generalist or somebody in Baltimore, they'll be, you know, the reason why I'd replay that is because it really puts the onus on the PM to find those stocks.
Yep.
And it's because we've had this razor burn for the last 3 years of everything's all or nothing.
Right.
And in your temperamental, you know, framework, well, there's a lot of new somethings, and they're not the former bubbles. They're not, you know, they're not whatever they're going to be. They have certain factor-based attributes that do well in the temperamental environment.
Hey, Kate, here's another kind of new thing. We probably talked about this before. I'm really driven crazy by the simplicity around the growth versus value debate, discussion, whatever it is, because I think you can think about growth and value sort of in 3 different ways. There's the actual characteristics of growth and value, which that's the way I think about it. There's the preconceived notions of what's a growth stock and what's a value stock. And then there's the actual indexes labeled growth and value. And on that third one, sometimes they can be entirely different. And here's a perfect example. On December 18th, so December 19th, the S&P did their rebalancing. Russell doesn't do it until June. So on December 18th, this past December, S&P Pure Growth, their regular growth index, the stocks can be in there, and they can also be in their regular value index. There can be overlap, which, you know, yeah, because lots of stocks have both characteristics. But if you're in pure growth, you're only in pure growth. On December 18th, all 8 of the mega cap 8, all the names we're familiar with, were in pure growth. And that index was 37% technology. On December 19th, only 1 was left in pure growth. The other 7 went into a combination of regular growth, regular value. Mm-hmm. And tech went from being 37% of S&P pure growth to 13% of pure growth, with energy the number 1 sector and healthcare the number 2 sector. Russell hasn't done their rebalancing. So last time I checked, Russell 1000 growth was still, you know, well over 30% tech. So even if you're saying, I'm focused on the indexes, well, you sure better know what you're buying if you're taking an index approach, because what you're getting in pure growth, S&P pure growth versus, say, Russell 1000 growth is entirely different in terms of the sector representation. Now I'll get off my growth value soapbox.
No, it's surgical. I mean, again and again and again, how many of you that are watching this are relatively new to this and want to learn, but didn't know that? I mean, it's okay not to know. I mean, I didn't know that.
It's okay not to know that.
Yeah, it's okay. You know,
it's not always that extreme. It's just, it was extreme this time because of the nature of growth being so concentrated last year in the energy sector. We don't think of energy as a growth sector, but that's where the actual earnings growth has been. Mm-hmm.
No, it's amazing to watch. I mean, NASDAQ, of the 9 companies, we can show it, 9 out of 100 have reported negative 38% earnings growth. I mean, it's a disaster. Right. Energy had 280% earnings growth, you know, in the back half of last year. So, yeah, very well said and surgical again. Okay, question here because we have 6 minutes left. You know, hi, Lizanne and Keith. I think you both recently commented on market sentiment being bullish and bearish, respectively. Could you elaborate on what your views are on this and the data so that you can compare it with each other further. I did very, very good question and a good time to ask it because I've seen quite a bit of everybody's bearish.
I think it's kind of a mixed bag here, depending on what sentiment indicators
Yes.
you're looking at, and in particular, attitudinal measures of sentiment, survey-based data versus behavioral measures of sentiment, but then also looking at sentiment as reflected by individual investors versus, say, institutions. In general, there's a bit more pessimism, but depends on what survey data you're looking at. It is the case that large speculators have a very ample short position in the S&P, but there are some measures, attitudinal measures of sentiment that have actually seen a bit more of an improvement, not into wildly bullish territory. Then you've got things like the put-call ratio, which I'm not sure, it hasn't been skewed a little bit recently, and maybe not sending as accurate a short-term sentiment signal. So I'd say sentiment is mixed to slightly bearish. The one thing I was saying last year was in June, when we had the initial whoosh low, attitudinal measures of sentiment like AAII were just in Armageddon despair, record low percentage of bulls, but you were not seeing it in the behavioral measures, be it put call or fund flows. And I was saying, you normally kind of not want to see the puke phase, but you generally see that. You saw that a little bit more in October. Now I'd say it's, leans pessimistic, meaning the sentiment is pessimistic, but it's pretty mixed.
Yeah, I spend basically all my time on positioning, because you telling me, from an attitudinal perspective, which is a long word for me, is one thing. But how you're positioned is entirely the most important thing. And February at the big lower high in the S&P or the Nasdaq, for that matter, I mean, it was the biggest call buying period in American history. I mean, it's not, people buying YOLO 0 days to expiration calls and Tesla weeklies every single week. I mean, that's not like I'm bearish. It's like I'm just outright thinking that this is the bull market I came into in 2020. Like there's that. There's also, right now, Lizanne, like the hedge fund prime brokerage data, we're in the 100th percentile of gross long exposure on a 1-year look back. I mean, that means people have it on. And 51% net long, which is in the 83rd percentile. So we're like up there. And then somebody will take, and why I think there's some confusion is people will look at the net short position, futures and options contracts in SPY, or S&P index and E-mini, and they'll say, oh, that's up a lot. Well, you need that to offset the gross long exposure that hedge funds have. That's their hedge. So I just gave my.
And if you look at, household exposure to equities, which is reported quarterly by the Fed, it has come down a bit just because that's what happens in a bear market.
Yeah.
That's just the way the math of numerator denominator works. But it is still in kind of the top quintile of historical ranges, where on a forward kind of 7 to 10 year look, it's a message of not, we're in a 7 to 10 year bear market, but curb your enthusiasm if you're expecting really robust historical returns over a horizon out to 10 years or so.
Yes, thank you for that. Last question, because that's all we have time for, unfortunately. I'm going to ask you the question that I hate answering, which is why I have not asked this question.
Well, what if I hate answering it too? We're going to end with no answer?
Yeah,
all right, fire away.
That can happen. You and I can do that. From Steve Wilson, good morning, Lizanne and Keith. Lots of opinions on earnings and the applicable multiple for that S&P 500. I'd enjoy to hear your perspective.
All right. Well, so we think of multiples. Let's just use PE ratio as sort of this quantifiable valuation metric because, we can quantify the P, we can quantify the E. Even if it's forward E, there's at least a consensus that we can use and plug it in. But the reality is valuation, and I often say, is as much a sentiment indicator or maybe an indicator of sentiment as it is some sort of fundamental dyed-in-the-wool thing. There are times when investors want to pay nothing for stocks, like early '09. And you got to single digit multiples, and there are times like circa 2000 where investors are willing to pay nosebleed valuations. If I was trying to be as quantitative as possible, and I have a cross section analysis that I do. It's a table that I show that looks at inflation ranges over the kind of modern history of the S&P, so back to the mid 50s. And not just what the average PE ratio was in each of those inflation zones, but importantly, the range around that. Because I think, I don't know who originally said it, analysis of an average leads to average analysis. And I always say shame on anybody that just talks about averages, especially when you don't have a large sample size. By definition, the actual outcome is never going to be the average, because the average is just the math. But it suggests that, at 18 or 19 times, given where inflation is, that's still pretty lofty. And the problem, of course, is that inflation, all else equal, is still putting downward pressure on multiples. But the fact that the forward E hasn't stabilized yet, that is putting upward pressure on multiples. So I think we need to see some combination of inflation coming down more, with a sense that it's not a short-lived move down and not going to spike back up again, but an actual stabilization in that forward E. And I'm not quite sure, but I don't ever look at it and say, as soon as the S&P is trading at a 14.8 multiple, I'll launch the confetti and say, the bottom is in. It's just not as simple as that.
If you did that, you and I would not have conversations at the Investing Summit. So
yeah,
I appreciate
Good
you.
Point.
Yeah, I appreciate you in general, but I appreciate you taking a crack at that answer. It's Benoit Mandelbrot who taught me, at least, through the textbooks and how he's thought about looking at markets fractally. It's not the averages of things. It's the particular things at the particular time in the cycle that matters. So,
Absolutely.
And I know it was just to close on this. I know it's not an easy day for you and your family, and you rallied, and most people probably couldn't notice that.
If anybody sees my Twitter feed, we had to say goodbye to our second dog in 6 months. So we went from 3 labs to 1 in the last 6 months. So, but thank you for giving me this distraction for an hour or so, Keith. It's always a pleasure.
Well, anytime you want to be distracted, but again, my thoughts are with you guys. I've gone through that, and that's a tough thing. But you're a gamer, and did you?
Thank you.
Did you play the game for the last 45 minutes? Thanks for spending it with us.
My pleasure.
She is Liz Ann Sonders, the one and only. Looking forward to having a new conversation with somebody I've not had one with on Hedgeye TV yet, Lynn Alden.